Let me quickly talk to you about IRS rules for Schedule K-1 basis, at risk, and passive activity limits. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. And if you are doing as wonderful as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to quickly really browse through the whole Schedule K-1 basis, at risk, and passive activity limits. Now, I just want to say that the information I'm sharing with you today stems from our own research as well as data gathered from the IRS official instructions. And if you need more information, you want to head to the two IRS web links indicated on the screen, or you can contact your tax advisor. So I'm first showing you the instructions for 1065, the Form 1065, the K1, and the instructions for Form 1120 as K1. Now, what is the difference between basis, at risk, and passive activity limits? Generally, your deductions cannot exceed your basis. Now, basis is more or less the amount you have invested in an activity, right? So let's say if you bought into a partnership or an S corporation for 10 grand, your basis is 10 grand. If the partnership passes losses and deduction out to you of, say, $1,000, your basis goes down to 9 grand. So next year, when there is a profit and your K1 shows 5,000 of income, your basis becomes 14,000 and so forth. So 9 plus 5,000. You cannot deduct losses once your basis reaches zero because you cannot lose more than you invested in the first place, right? That's kind of logic. It's kind of logical. Now, losses that are suspended due to the lack of basis are carried forward on the basis worksheet. They will not show on any other form or schedule until the year the basis is restored. Then they will actually carry to the appropriate forms along with any current year status and amount. So if you need more info, you could go to publication 551, basis of assets. We're showing you on the screen the publication as well as the link. And one thing I also want to say is that losses in excess of basis, stock, or debt are not allowed in the current year. So if you don't provide basis calculation with the return when required, you as a taxpayer will get a letter 5969 in the mail, and nobody wants to get that letter. And we're showing you a snapshot of that letter, and nobody wants to get that letter from the IRS. Believe me. So the one thing I want to see here is that if you are not comfortable with the basis calculation, you can talk to an accountant or an EA, or you can actually use software, okay? Because under IRS rules, basis is tracked at both the 1065 or 1120S level and the 1040 level. However, the worksheets are not always the same between the business and individual returns. So the inside basis, what we call the inside basis, is calculated at the partnership or S corp level, while the outside basis is calculated at the partner shareholder level. And all the final calculations and limitations are applied at the individual Form 1040 level. Now let me quickly cover, so I talked about basis limits. Let me talk about at-risk limits. So generally, your deductions cannot exceed the amount you have at risk, right? I've already said that. So roughly, an amount at risk is any amount you invested and could lose. So an amount not at risk exists when there is a part of your investment basis that you are protected from losing. And this might occur because, let's say, you bought your interest in the business with money that you borrowed through a non-recourse loan, for example. So since you're not personally responsible for the debt, you're considered not at risk for that borrowed amount. And another scenario could be that you have a stop loss agreement in which the other partners have agreed to reimburse you for a portion of any losses you might have in relation to the business. And the third criterion, or the third hypothesis here, is that you borrowed some of the money you have invested in the business from one of the other partners. So the amount you have at risk is kind of analogous to basis in that you cannot deduct losses in excess of your at-risk amount. And the amount at risk, however, is not the same as basis. So in many cases, a taxpayer can still have basis, but his or her losses, are not deductible because they are limited by the amount at risk. And if you need more information, I would suggest you head to publication 925. We're putting this on the screen right now. This is the IRS publication that sort of explains everything. What about passive activity limits? Now, generally, you cannot deduct expenses from a passive activity against income that is not from a passive activity. So a passive activity is a trade or a business activity in which you do not materially participate during the year, right? Again, we have the concept of material participation. Material in accounting or tax matters means significant. It means substantial. So a passive activity can be a trade or a business activity in which you do not materially participate, or a rental activity, even if you do materially participate, unless you are a real estate professional. And if you need more info here, you want to head to publication 925 again, and you can read more about those rules. The limits imposed by IRS rules dealing with basis, at-risk activity, and passive activity are applied in that specific order. So only the amount that does not exceed basis should be carried to the next steps. So the main form 6198 or form 8582, as the case may be. Remember that form 6198 is used to figure at-risk limits. Form 8582 is used to figure passive activity limits. What about partners and partnerships? Now, individuals who invest in partnerships need to be aware of the rules that limit their ability of partners to deduct losses. This is very important, folks. If you are in that situation, you want to pay attention. So individual partners who have been allocated a distributive share of loss must satisfy 3 separate loss limitations before the loss can be used. So the loss limitations in the order in which they are applied include the Section 704 basis limitation, the at-risk limitation of Section 465, and the passive loss limitation of Section 469. So this item focuses on the application of the Section 704 basis limitation and the at-risk limitation for individual partners, and does not discuss the application of the passive loss rules. So let me quickly sort of talk about the Section 704D. So a partner's distributive share of loss is allowable to the extent of the partner's adjusted tax basis in his or her interest in the partnership at the end of the partnership year in which the loss incurred. So if you were part of a partnership and the loss incurred this year, you can actually, this rules applies to you when you file your taxes for this year. All right. So any losses in excess of the partner's tax basis are disallowed. In other words, they are not authorized pro rata, and they are carried forward indefinitely for as long as the partner remains in the partnership. And a partner's adjusted basis in his interest, in his or her interest in the partnership, includes the amount of money and the adjusted basis of property contributed to the partnership increased by any gain recognized on the contribution. Very important to understand, folks. And Section 704D, I'm actually showing you right now on the screen, courtesy of the Cornell Law School, Cornell University. And we're showing you the link as well as the snapshot of it. And if you want more information, I would strongly advise you to go there. We actually have two snapshots. The first one is Section 752, which provides that an increase in a partner's share of the partnership liabilities, or any increase in a partner's individual liabilities because the partner assumed those liabilities, is considered a contribution of money by the partner to a partnership. That's for 752A. And the second screenshot I'm showing you here is for 704D. All right. You can see those two on the screen right now. All right. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. I'm still having a convo with you about IRS rules for Schedule K-1 basis, at risk, and passive activity limits. Now, let's talk a little bit about at-risk rules. So for individuals, estates, trust, and closely held C Corps, deductions of business or investment-related losses from an activity for a tax year are limited to the amount the taxpayer has at risk. It's very important. So the amount at risk includes what? It includes the amounts of money and the adjusted basis of property contributed to an activity, amounts borrowed with respect to the activity, to the extent the taxpayer is personally liable for a repayment or has pledged property, other than property used in the activity, as security for the borrowed amount, and generally you have any amount borrowed with respect to the activity of holding real property for which no person is personally liable for repayment, qualified non-recourse financing. Okay, so this is kind of important to understand. And if you are a K-1 partner, one thing I want to tell you here is that the amount at risk is also increased by the excess of items of income from an activity for the tax year over items of deduction for the activity for that tax year. And one quintessential in our research item that we have seen is that unlike a partner's tax basis, the amount at risk can go negative, although not from recognition of losses. The consequence of a negative at-risk amount is that the potential for what the IRS calls at-risk recapture. In other words, it is simply the recognition of previously deducted losses as income in a year in which the taxpayer's amount at risk is negative, often as the result of a distribution. All right. And one thing you have to know here is that recognition of at-risk recapture definitely increases the partner's amount at risk, and this has consequences on your tax returns. If you are a K-1 partner, you're going to have some repercussions, if you will, on your 1040 when you file it. I want to elaborate on the definition of loss for purposes of at-risk rules. This is another important element when we talk about Schedule K-1 basis, at-risk, and passive activity limits. Now, the at-risk rules do not limit the deductibility of all deductible expenses arising from an activity. Rather, they limit the deductibility of losses. That's the key word here, the losses. Not the expenses, the losses. So a loss in this context is defined as the excess of otherwise allowable deductions allocable to an activity over income received from the activity for the tax year. All right, let me just clarify that because this might sound like legalese here. It means that even in a year in which a taxpayer's at-risk amount is zero or negative, the taxpayer can still deduct expenses up to the amount of income from the same activity. It has to be the same activity. Very important. All right. And the one thing I want to say here is that the rule permitting deductions to the extent of current year income from the same activity applies even if a partner receives a distribution from the partnership in the same year that causes the partner's at-risk amount to go negative. And a partnership may fund initial losses and or distributions to its partners by incurring debt, right? And what happens here is that the allocation of non-recourse debt to a partner provides tax basis to avoid loss limitation under Section 704D. And what it also does is that it can facilitate tax-free distributions. Of course, here you have to think about the at-risk recapture. Now, folks, if you want us to have an entire show on at-risk recapture, that topic, please put in the comment below, and we'll be very happy to do. If we see a lot of passion for the topic, we'll certainly do it. Okay, this is very important. Now, I want to also talk about partnership recourse debt and limited partners or S Corp members. A partnership's incurring recourse debt does not necessarily result in the partners being deemed at risk for a ratable share of the debt. All right, so because you have limited partners, you have general partners, right? So limited partners, for example, and members of a limited liability company generally are not considered at risk for partnership recourse debt, and the mere existence of a deficit restoration obligation, DRO, does not necessarily change this result. Again, this is another term that we would love to elaborate on the DRO. So if you want us to talk about that, please comment below. We'll be very happy to cover it. Now, continue the conversation on Schedule K-1 basis at risk and passive activity limits. I want to talk about the disposition of a partnership interest. In other words, if you sell your shares, or if you transfer a property, whatever disposition of partnership interest happens, there are specific rules. So recognition of gain from the disposition of all or part of an activity, including gain from the distribution and disposition or liquidation of a partnership interest, is treated as income from the activity. The IRS looks at it as ka-ching, ka-ching, ka-ching. That's money coming to you, right? So what happens here is that it increases, this transaction increases a partner's amount at risk. And this provision enables a partner to deduct losses previously suspended under the at-risk rules to the extent gain is recognized. And this is an important distinction, if you were to ask me. Why? Because you have, on the other hand, you have there is a tax basis limitation, right? But here, the distinction from the tax basis limitation is great because gain from the disposition of a partnership interest does not increase a partner's tax basis, and suspended losses therefore do not offset gain on disposition. So if a partner or a transferor with suspended at-risk losses disposes of a partnership interest in a non-recognition transaction in which, let's say, the basis of the transferee is determined in whole or in part by reference to the basis of the transfer, then what happened here? The transferee will increase its basis in the property by the amount of the transferor's suspended at-risk losses. Okay, and this is a topic that I would love to actually expand on if we see popular demand, because we don't have time in this show to sort of dig deeper. But if we see popular demand, we'll be very happy to actually cover that. So the bottom line here, folks, I just want to really kind of recap things here. When a partner's tax basis and at-risk amounts have been substantially diminished, losses allocated to the partner may not be deductible, and distributions to the partner may result in income recognition. So a partner may avoid these consequences by being aware of his or her tax basis and amount at risk, and by taking measures to increase these amounts prior to the anticipated events. And a partner's tax basis and at-risk amount increase through the receipt of a share of partnership income. And speaking of the partner's partnership income, he or she may also increase tax basis and at-risk amounts by contributing capital to the partnership or by guaranteeing a portion of partnership debt. All right, folks, this is it for today's conversation. I want to quickly sort of give you the summary here. I spoke to you about basis limits, at-risk limits, passive activity limits, at-risk rules, laws defined for purposes of at-risk rules, partnership recourse debt and limited partners or members, and the disposition, what happens in the disposition of partnership interest. Thank you so much for your attention. I really appreciate it. I will see you next time, but until then, remember, stay marvelous.